Hello, everyone. Hope you had a great and wonderful weekend. This is Sam Wall from Finance Analytics Services team. Last week, or even now, the market is still focused on the war, and then in the U.S. side is also on the interest rate that's pending on March 16 meeting if they're going to be a rise, and also definitely the oil prices that's surging that brings the concern also inflation. But just to look at a snapshot real quick on a week, the market actually for Dow Jones Industrial Average was only down 0.76% because, Thursday, just like previous week as well, there was a reversal when the market was taking very back and that kind of picked it up. So if you caught the reversal buy on a day trade the following day, I mean, you have been surging back and you sell, you're probably in a pretty good profit. So for short-term strategy, right now, probably that would be something to consider if you're not doing put options, which could be, if you bet on the wrong direction, you can lose a lot of money, then that may be something you can consider. Same thing in NASDAQ, it was it was down for 1.9%, which is more than Dow Jones Industrial Average for the last week. And again, there was a spike on the Thursday that they're picking it up. Actually Wednesday, as Powell came out to talk about the potential interest rate increase and what his thought about and in his remark, he also believed that the inflation in oil prices perhaps would be longer than anticipated. The other thing I want to point it out too is which I will talk through about the United Airlines and the cruise. And if you notice that actually for the week it was down 6%, quite a bit, quite a lot, in particular most of them happening on Friday. And then for year to date, in this case, United Airlines is still down 20%, almost, which I still think this is really a good stock to buy for the long term, which I will get into the story later. And also, the other favorite subject, which is Tesla. Tesla also for a month have done 7.61% at $838. And again, a 1 year high was 1243.49. Um, this one. So before talking about getting into the week recap really quickly, which I will give a very highlight and snapshot on this time because I want to focus on other graph and other things that was actually more to look forward in the future. How is it going to look? The futures right now currently is not very favorable, which kind of anticipated as the war continued to drag on. So Nasdaq is down 247 points, 1.78%. Dow down 370 points, 1.1%. S&P down 1.36%, 59. Just remember that this is futures and it's subject to change and based on the actual opening, the performance of in the volume when the market opens. But that gave you a really good indicator that it's still not doing well. And Hansen Index at the moment, which is at noon around one close to 1 p.m. actually in Hong Kong time. You can argue that that's due to the the pandemic surge and all the things that going on, the potential shutdown. So the market down 3.41%, which is very serious. 746 points down, 21,159 for the index. Next, Nikkei is also facing very big challenge right now. It's down 3.23% as well, 840 points, which is 25,145.43. So having said that, meaning that the market, with the futures as well as going down, it's just not betting favorably. But sometime when before the market, closes actually, which is probably 2 hours away, the market may be actually pick up from the deep of the day and it will be driving back up. So it's very hard to say, but that definitely gives you some indications of how the market looks like right now. And the European market also, you just we'll see how how it shapes up. That will have some influence in driving to how it looks like in the U.S. market. But currently, the market hasn't doesn't have to do much yet. So. But again, the futures is going down, so but sometimes you see that for a few days, the futures is start actually kind of revert back, open up much narrower, and then eventually with news to driving actually turn up to positive. So this is one of the figures as people very concerned about how much presence of Russian asset in the bank industry, because you can see the bank stock actually get hammered as well in the last couple of days. U.S. bank actually 16%, Italian bank at 28%, and French bank at 28%. This is based on the third quarter 2021 data. Just bear in mind, but it should be pretty consistent, pretty close. But the picture is not pretty here, as you tell. U.S. actually have quite a bit of presence as well, 16%, but Japanese bank as well, but the UK bank actually not having a lot. So that kind of explaining why the bank stock were down actually last week. Particularly in JP Morgan, it actually pulled back from $152 to $134.50 in less than a month. So that's just something to give you some idea of that. And then I also get to this oil prices too, as the graph as we get down to total oil price before wrapping up of this of today's presentations of this video. So it's coming back to the Nasdaq, JP Dow Jones Industrial Average and Nasdaq the index, just to put up there. So now I'm just give you a quick recap what happened last week. Just global stock basically tumble Monday, which hopefully is not going to be the case tomorrow, but you can see the Asian market when they're dropping a 3% plus is pretty serious. The power also agreed to impose merger that effectively frees the Russian central bank in the National Reserve, which is kind of the bank picture that I showed you the bar chart earlier. So, and BP fell 7% after saying it would abandon its stake in Russian oil major. Potentially take a 25 billion hit. Shell also said it will exit its Russian operation, including a major liquefied natural gas plant. And as the result came out, Shell also get a really pullback from $54.30 down back to 48-ish. So this is another 12% hit. Norway's Equator also planned for exit Russia. The stock also has experienced some pullback as well as after the announcement. Among the biggest decline, the Citigroup fell more 4%, warning of 5.4 billion hit from exposure to Russian asset. JP Morgan also suspends its emerging Euro fund and Russia fund. And again, that stock I just walked through it is dropped to $134.50 for Friday. Apple said that it will suspend all online product sales to Russia. Zoom video communication, which is simple CM, also fell 7% as quarterly result beat on both top and bottom line were offset by the first quarter and full year guidance that pointed slowing normalizing demand for video conferencing software. Salesforce report revenue increased 26% in fiscal fourth quarter, topping Wall Street average projection. RBC cut its price target on Zoom to $200 from $300. Powell said he will back a quarter point rate increase when the Fed meet March 15-16, effective point to rest debate over starting a post-pandemic round of rate hikes with a larger than usual half point increase. So that is also the good news that's driving why the market was back up from a reversal on Wednesday. This is also driven by the non-strong and Salesforce posting stronger than expected result. Volkswagen became the latest to say it will stop production in Russia, while fast fashion giant H&M and IKEA also said they will suspend operation there. Toyota and GM didn't produce anything in Russia, but they also say they will stop export there. Friday market sell off is just because of the power plant story. Snowflake SNOW slumped 15% after reporting fourth quarter result. W Wall Street estimate, but guidance fell short. Best Buy simple BBY jumped about 9% despite quarterly revenue and full year guidance below analyst estimate. Kroger simple KR surged 13% after reporting earnings per share of 91 cents, a revenue of 33.1 billion. The beat estimate 74 cents. The event stock also were on the rise because there's really a fear and the tension about the Ukraine and Russia conflict, in which somebody want to make a storyline World War III, which I hope is not going to happen, or the end of the world. And I no longer have to talk about this show because the stock market will be really tempered to pretty much nothing. So, and I want to give you a market wrap up though. Despite all this bad news and the market have, you can argue in a correction and the U.S. economy is in recessions because the oil prices jump up so much. Fund strat Tom Lee said the stock market is in the eye of the storm of uncertainty, but said it's already hit bottom as opposed to bounce. Louis Leverly, a fund manager who in the industry over 20 years, also indicated that mid-March market outlook will be better than when funds start window dressing and April earnings start releasing again. So there's some people still looking positive about the market and still projecting. Despite all this storm way now, at end of the year, still looking higher than where it were a month ago. And the oil price, which is this picture that's showing you, really is talking about the U.S. gas production recovering much faster than crude oil. This is like gas production because gas in the winter time so cold you need it to burn and make you warm. In Europe in particularly, that's where the tension started. Russia providing the supplies to Europe because they really needed it and it was being supplied by Russia. You can see the prices actually been really at in October 21st, which is here, so to December, right? You're really at the peak and you really have gone back up a lot. And now we know that, for the futures, if you look at the prices, it's actually going to $120 a barrel. So we will see how when U.S. market open, the traders, which are really the trade in the Asia area and in Europe, how the price going to price it in to go up. J.P. Morgan analysts estimate in Thursday that crude prices could skyrocket to 185 by end of year. And so originally they were project $150 because of the raw. Now they probably put a modeling together again with all the uncertainty and how the spike of the price lately, which is probably maybe projected faster than anticipated. So then now they actually rise their forecast $185 by end of the year if Russian oil demand remains disrupted, which is Biden trying to make it light and not really try not to talk about the not using Russian oil, and then actually get it from Iran, but. This is actually, we'll see how it happen. Again, for those who listen to my video, the Russian oil is really 11% of the global market today. So that does have disrupted when you suddenly take off that much, right? World food prices hit a record high in February, led by a surge in vegetable oil and dairy products. They posted a 20.7% increase year on year. The United Nations Food Agency said on Friday. Higher food prices have contributed to a broader surge in inflation as economy recovered from coronavirus crisis. So inflation is continue, especially on food as well as it's really showing up higher than what we're really looking at. And then the other thing I want to demonstrate is Friday there was reporting of the employment number. So the Labor Department reported that U.S. economy created 678,000 jobs last month, well above estimate for 440,000. The unemployment rate slipped to 3.8% from 4%. Our research shows that, however, if you see this, which is the research saying job mismatch between job seeker and employer interest, because the media trying to blame or trying to say the reason why you didn't have, as many people working, and there's a lot of basically opening, in the U.S. economy and job market right now. But this research basically showing that wasn't really a true reasons. That's why I always said you have to be careful about what media you're reading, what you're listening, and a lot of time you have to use your intelligence these days to make sure things were really, really staying out of fact. So the research showed that employers are struggling to attract and keep employees around as Americans leave for the other job where they could make more money, be less stressed, have more flexibility, or not be part of a toxic office. While companies are competing to find talent, some businesses are having trouble getting applicants even show up for interviews. I didn't find that true because I think that a lot of people actually looking for a job were fighting for those interview slots. One common explanation is that workers aren't looking for the type of job employers have on offer and potential is let the skill for the position to open. But this is just a dilemma, okay? But as seen in the chart, though, this is what's showing. Um, we will lead to reallocate about fifth of job seekers clicks to balance the market so the job seekers' interest and employee interest align. Pay could be one reason, but the increase of salary for many jobs should overcome this issue. But a lot of people have said that there's been increasing mismatch, particularly in the last couple of years. And that's actually not what we have seen, which is this graph is showing. In fact, as the labor market has tightened generally, we have actually seen mismatch decline somewhat. The messaging in this problem is more perceptions rather than fact, according to research. It's still tough though, for sure, if you are in the office trying to find office jobs. So there's a lot of jobs definitely in the lower level, the labor type of work, like Starbucks, people serving in the cinemas, or people, being a cashier in a retail store. But really in the office job is still, I think there's still a lot of, with the elimination because of the pandemic, there's still very pretty remain challenge. But I just want to point this out to you. This is a very, very interesting research that I want to share with you. To my fans. This one I will cover. This one cover. Now the last one we want to talk about the airline stock. So even though it sounds like the stock have been dropping in a way, or like showing you with the graph above, the United Airlines is an example because some other airline you pull, it was actually dropping on Friday, and on the year-to-day basis, it dropped about 15 to 20%. That's still, some time you can blame and think about because of the surge of oil prices, but actually, there was indication that this is not the reason. In fact, if you look at the history statistic here with the graph, it's kind of show you that the airline stock actually continues sour the next few years, not just because the oil market collapsed, but because carrier have become leaner and more efficient. They learn to pack more people on the flight. As you know, really when you look at plane, there's a lot of sunk costs, whether you fly one person or 10 people, 20 people, it's the same cost. So, they found a way how to do a scheduling and doing a way effectively to try to arrange people into the same plane, which actually help them to make more money. They also practice capacity discipline by getting rid of unprofitable routes. So something they don't make money, then they just say we're not flying anymore. And they start charging extra for perks and services that used to be included in price of a ticket. So that's another good reason how they make money, like internet will be one of them. In 2012, these ancillary fees generate under 40 billion for global carrier, and by 2019, they were responsible for bringing in close to 110 billion. So I'm just trying to, get you to get the idea that, even though the fees fell in dollar terms due to the pandemic, they continue to represent large share of global airline revenue, which should help the company offset rising cost of fuel. And that's why I'm still bullish in terms of airline. Of course, it's war now, and also pandemic still going on with Asia. So you can see that probably not as a lot of airline company get hammered again. But in the long run, if you think about it, and again, United Airlines at one time pre-pandemic was at $92 and dropped as low as I think around $10 or $15. So it's really a great buy right now, even though it's as 30 something, because as soon as the war is getting better, this stock can potentially just drive back to $43 easy. So just something to think about. I just want to also illustrate that to you. So again, the market, yes, right now it's still really rough, but just like my my podcast or video, the last 2 or 3 weeks, because of the war and inflation pressure last month, the stock market started to be at the unfavorable and keep having a lot of pressure with yield curve that's kind of rise to 2%. But lately the yield curve also have dropped a little bit to 1.8%. So just something to and also the Bitcoin currency got beat up as well lately. So that has something to kind of explain the Tesla positions and why the stock was going down. But there's still a lot of people looking at long term still believe that it's very bullish of the market, and I really think my theory is still like that. If you lost 20% and you don't think the war you can want to withdraw in 3 to 6 months and you don't want to hold for that long for the rebound, then yes, you probably want to take a loss of 20% of one from it. But you've already lost 40%, 50% at this point. Is another 10% matter to you? So you probably is better off to wait, right? If the market, worst case scenario, if there's no World War III, World War III again, I don't even think the stock market even exists anymore. We don't even talk about it. But if it's not, and you could be corrected another 20%, let's say another 20%, then by that time you probably hopefully maybe in 3 months from now, if it keep dragging, you will be good opportunity to buy in. And in the history tell you this also, if you put a graph on the recessions, you actually the first 6 months of half of the year was kind of weak. Then the second half of the year normally start to rebounding the stock, but you may actually have to drag for really 2 or 3 years to go back to bullishness again. So I hope you like my video. Have a nice and wonderful week.